Margin trading is one of those concepts that sounds deceptively simple, yet carries consequences that permanently change an investor's trajectory if misunderstood. At its surface, margin trading means borrowing money from a broker to increase the size of your position. You put up a portion of your own capital, the broker lends you the rest, and you control a larger exposure than your cash alone would allow. This amplification is what attracts people, and it is also what quietly destroys many accounts. Margin is not just a financial tool, it is a psychological accelerator, and anything that accelerates emotion deserves deep respect before it is ever used. The first thing to understand is that margin does not change the quality of your decision. It only changes the speed and magnitude of the outcome. If your trade is right, gains arrive faster and feel impressive. If your trade is wrong, losses arrive faster and feel personal. Margin does not improve skill insight or timing. It simply compresses time. Many investors mistake this compression for efficiency, when in reality it is fragility. What might have been a recoverable mistake without margin becomes a defining blow with it. Margin trading also introduces an obligation that does not exist in cash investing. The broker's rules now matter more than your opinion. When you trade on margin, your account must maintain a minimum equity level known as maintenance margin. If losses push your equity below that threshold, the broker issues a margin call demanding additional funds. If you cannot meet it immediately, positions can be liquidated without your consent. This is a critical distinction. In a cash account, you choose when to sell. In a margin account, the broker can choose for you, often at the worst possible moment. Another common misconception is that margin is primarily about greed. In reality, it is more often about impatience. Investors use margin not because they want infinite wealth, but because they want results faster. They believe they have identified an opportunity and do not want to wait for capital to grow organically. This mindset underestimates uncertainty. Markets rarely move in straight lines, and even correct ideas experience drawdowns. Margin removes the buffer that allows time to absorb those drawdowns. It turns normal volatility into existential risk. Margin also interacts dangerously with confidence cycles. Early success with margin often reinforces the belief that leverage is manageable. Small wins feel validating. Position sizes grow. Risk tolerance silently increases. When the inevitable adverse move arrives, the account is no longer positioned for learning, but for damage. This pattern is so common that it defines the margin experience for many traders. The problem is not margin itself, but how quickly it encourages behavior that outpaces discipline. It is also important to distinguish between strategic leverage and casual leverage. Institutions use leverage as part of carefully structured systems, with strict risk controls, diversification, and liquidity planning. Retail investors often use margin opportunistically, adding leverage because it is available rather than because it is required by the strategy. Availability is not justification. Just because you can borrow does not mean you should. Margin is safest when it is integral to a tested process, not when it is an afterthought layered on top of hope. Another overlooked aspect is emotional distortion. Trading on margin changes how price movement feels. Small fluctuations become stressful. Pullbacks feel threatening. Patience erodes. Decisions that were easy in a cash account become emotionally charged. Many investors believe they can handle the pressure until they experience it repeatedly. Margin exposes emotional weaknesses faster than almost any other tool in finance. This is why it often ends learning rather than accelerating it. Margin trading also creates a symmetry of risk. Gains are capped by market movement, but losses can exceed your initial capital. In extreme cases, investors owe money after liquidation. While this is rare in regulated equity markets, the psychological effect of knowing it is possible alters decision-making in subtle but harmful ways. Fear and urgency creep into every tick. Margin changes not just outcomes, but behavior throughout the trade. This does not mean margin has no place. Used conservatively, margin can improve capital efficiency, especially for short-term strategies, hedging, or professional traders with strict rules. But margin is not a default upgrade from cash trading. It is a different game with different rules. The question is not whether margin can increase returns. It clearly can. The real question is whether it increases the probability that you will make irreversible mistakes. Before anyone uses margin, they should ask a more honest question than, "How much can I make?" They should ask, "What happens if I am wrong at the worst possible time?" Margin forces this question into reality. It does not allow comfortable answers. In recognizing this margin, trading becomes less seductive and more serious. It stops being about opportunity and starts being about responsibility. Responsibility to capital, to emotional stability, and to long-term survival. Without that mindset, margin is not a tool. It is a shortcut to regret. And this brings us naturally to the deeper issue, because understanding what margin is does not automatically answer whether you should use it. And determining that requires a clear framework for suitability, risk control, and self-awareness, which is exactly where we need to go next. By examining when margin trading can make sense, when it almost certainly does not, and how an investor can decide honestly which side of that line they are on. And that is where we will continue by looking at when margin trading can make sense and when it almost certainly does not, because the difference lies less in market conditions and more in the trader's structure, experience, and self-awareness. Margin trading is most appropriate only after a trader has demonstrated consistency without leverage. This means a proven strategy executed over many trades across different conditions with controlled drawdowns and disciplined risk management. Margin should never be used to discover whether a strategy works. It should only be considered once evidence already exists that it does. Using margin to see if something works faster is how learning curves end prematurely. Margin begins to make sense when it is used sparingly and deliberately, not as a default setting. Professionals who use margin rarely operate near maximum allowable leverage. They often use a fraction of what is available, treating margin as a buffer for capital efficiency rather than a multiplier for returns. This restraint preserves flexibility. It allows positions to breathe through normal volatility and reduces the likelihood of forced liquidation. If your plan requires using most of the available margin to feel worthwhile, the plan is already too fragile. Margin is also more defensible when paired with high liquidity and clear exits. Instruments that trade deeply and continuously reduce the risk of sudden gaps and slippage. Strategies with predefined stops, position size limits, and daily loss caps are better suited to margin than discretionary, intuition-driven approaches. Margin punishes ambiguity. The clearer the rules, the lower the damage when things go wrong. There are also situations where margin is structurally dangerous, regardless of confidence. Long-term investing on margin is one of the most common and costly mistakes. Markets can remain irrational longer than margin accounts can remain solvent. Even strong businesses experience drawdowns that exceed expectations. Using margin in long-term portfolios converts volatility into existential risk and often forces selling at the worst possible time. This is why margin is almost always incompatible with patience-based investing. Margin is similarly ill-suited for emotionally reactive traders. If losses trigger anger, fear, or impulsive behavior, margin will amplify those responses. The question is not whether you want to be disciplined, but whether you have proven discipline under stress. Margin does not create discipline. it exposes its absence. Traders who are still struggling with basic risk control should see margin as a signal to slow down, not speed up. A practical self-assessment helps clarify suitability. Ask yourself, have I traded through multiple drawdowns without changing rules? Can I accept a string of losses without increasing size to make it back? Do I consistently define risk before entry and respect stops? If any of these answers are no, margin is not a tool yet. It is a liability. Honesty here saves far more than caution ever costs. If margin is used, risk must be capped at the account level, not just the trade level. Daily and weekly loss limits, maximum exposure. Rules and automatic position reduction after drawdowns create layers of protection. Margin demands redundancy in risk control. Relying on a single stop or a single rule is insufficient when leverage is involved. Perhaps the most important realization is that margin does not improve long-term expectancy. It redistributes outcomes in time. Gains arrive faster, losses arrive faster, and mistakes are punished more harshly. For traders who already have an edge and discipline, this can be efficient. For everyone else, it is corrosive. The market does not care which category you believe you are in. In the end, the question, should you use margin, is not answered by opportunity, confidence, or market conditions. It is answered by preparation, restraint, and self-knowledge. Margin is not a rite of passage. It is a responsibility. Many successful traders never use it at all. Those who do tend to treat it with caution bordering on suspicion. If this discussion helped you reassess margin trading with more clarity and less temptation, consider subscribing to stay with these long-form conversations focused on survival before speed, and leave a comment sharing what initially made margin trading appealing to you, because that attraction often reveals whether margin is a tool you should master carefully or avoid entirely.